Very warm welcome, good afternoon, good morning. Welcome to live market analysis with myself, Giles Coughlin, a chief currency analyst. I hope everybody is doing well. Good to see you here, Kingsley. Nice to see you here, Richard. Warren, pleasure as always. Suman, Naha, Johan, Ezwa, I think this might be your first time. Very warm welcome. Good to see some friendly, familiar faces back. If you are here and this is your first time, please remember that you can ask questions as we go through the webinar using either the question or the chat box. And if you have any problems, please do let me know. If you could let me know if my screen and sound are coming through okay, that would be great, so that I know that you can see my screen and hear my voice. Always good to have that extra level of reassurance before I kick off and then realize that something's not quite right. Just see. Okay, no one's put anything in the Q&A box or the chat box, but I am assuming you can hear me okay. So any issues, please do let me know. Screen shares okay, broadcast started, microphones on. So I think that I'm okay. Johan, thank you very much. All good. Excellent. Right. Well, I'm really looking forward to today's session because this is one of those markets when you need to have context. Yeah, thanks, Kingsley. And I'm going to just be putting us through the key context of where we're currently at. Now, if you look at, just before we get going, don't forget we talk about different entries, exits. I will be sharing a gold position that I've just opened today, and I'll explain to you the rationale behind it. Don't forget, as we talk about different entries, exits, instruments, the whole idea of this webinar, it's not meant to be a signal trading service, but it's meant to be an educational service. So you get behind my shoulders, as it were, and you see how I go about understanding the market, and that should help give you a better context to the market and help with trading decisions. Now, some of the things we'll be looking at this week was the US dollar. Has the Fed made a policy mistake? I'll be running through that with you. What about dip buyers on the New Zealand dollar yen? The Bank of Japan confirmed ongoing yen weakness. So I'll be explaining what that yen weakness is, why it's there, and what's the catch with it. The pound, we'll briefly look at the pounds, and Governor Bailey's had some comments out this morning, which has just been weakening the pound again. Gold, are we into a super cycle? Running through that outlook, and the Russian-Ukraine crisis, what's the peace trade? So if there's suddenly peace is announced, what's a currency pair that should gain? And you probably noticed over the course of this crisis that usually risk-off trading would result in New Zealand dollar weakness and Australian dollar weakness. And actually, we've been seeing strength in the commodity-based currencies, which is unusual for risk-off trading. But the reason is, and the clue is in the name, New Zealand dollar, Australian dollar are commodity-based currencies. So the fact that we've seen a surge in commodity prices has lifted the Antipodeans, the New Zealand dollar, the Australian dollar, the Canadian dollar. And also, because the Ukraine-Russia crisis is a long way from Australia and New Zealand, we've also seen some inflows into the Aussie and the New Zealand dollar just on moving money out of Europe in particular. That's what we're looking at. We'll also have a quick look at the general economic calendar that we have this week. And this week, the main real driver that we have is the US economic data, and I'll explain what's going on. So in order to start markets, we've got to look at this. Now, this is from my work as an analyst over at Financial Source. This was put together by one of my colleagues, and it's a very helpful tool, because if you look on this chart, you will see a grey band. Now, that grey band is whenever a US recession is taking place, okay? And if you notice that inflation, which is the blue line, and the 10-year yields and the 2-year yields, do you see how heading into a recession, inflation rises, yields rise? And then there's a recession, yields fall, inflation falls. Heading into a recession, yields are rising, there's a slight rise in inflation just before, and then recession, and then out of it, you see yields falling and inflation falling. yields, inflation falling, rising into an inflation and then falling outside of it. Now, what's going on here is when the Federal Reserve hikes interest rates, that makes conditions more difficult for companies because lending costs more. And if interest rates rise very quickly, as they are doing at the moment, and just to underscore that, let me show you this. This is the US implied probability rates for this year, and you can see that over 200 basis points is being priced in for the Federal Reserve's action, which means 9 rate hikes. So if interest rates rise very quickly, then all of a sudden mortgage rates cost more, new debt costs more. It means consumers have less disposable income. And once there's less disposable income around, future probability is hit, and then you will see a correction in stocks. Now, notice we're not there yet, okay? Because you can see here that inflation's rising, yields are rising, right? And 2s are rising faster than 10s. So we've got a little bit, we're moving towards an inverted yield curve, which is another recession indicator. So we're heading very close to a potential recession that's being driven by high inflation and the Federal Reserve having to act quickly to counter high inflation. You see, inflation hasn't been this high since the 1980s, right? Really, really rocking. And interest rates were extremely high around that time in the 70s, 80s, and mortgage rates went up to like 15, 16+% here in the United Kingdom. So obviously, if we have a surge higher in interest rates, and if you think about, in the UK, anyone under the age of 40 in the United Kingdom hasn't seen high interest rates. They haven't experienced, the high inflation. So what that means is there's a whole generation of homeowners who are ill prepared for high interest rates. Now, once interest rates start rising higher, that means that disposable income for consumers just gets hit, and that prompts slowing growth. Now, in the US, if we see slowing growth, and this week this is going to be the main story for this week. If we see slowing growth, slowing economic data, then recessionary fears will gain, and that will increase calls that we're in a stagflationary environment, and a stagflationary environment really boosts gold's outlook very, very strongly. So if I just show you this other chart, this very helpful grid. Hang on, let me just show you this. Hopefully this will just if you just look here at the do you see, if we get stagflation, which is high inflation, we've got that. Now if growth slows, then we've got a stagflationary environment that suits the dollar, suits gold, suits long bonds, suits energy. And that's the kind of environment that we may be heading into, right? And that's what the market's looking at. Now, that is not a good environment for stocks, but it is a good environment for gold. So with all that being said, we should be able to see now that this move higher in stocks is a difficult move to chase, because let me give you a clue here. It's not that stocks can't move higher when interest rates are rising. That can happen. But the issue here, and this is the question that everyone's trying to answer, is US growth slowing? So if we see US growth slowing, but interest rates rising, that is a situation very similar to 2018, when we suddenly saw slowing growth, yet interest rates hiking, and that resulted in a heavy sell-off. So is this latest move just a bear market rally? Put it this way, I'm not sure. So I'm not buying stocks at this level, and neither am I selling them, but I'm waiting for that US economic growth story. So stocks I'm quite neutral on, but China's 50 index looks very attractive. Now, the difference between China's 50 index is that Chinese stocks are in a totally different place to European and US stocks. China stocks have already fallen 40% since last year. They've tested this key trend line going back to 2014. They put in a very technical, strong reversal bar on the weekly chart. You see you have this big bullish reversal candle with a large wick, bullish close, big space to the left. You would expect to move back up to 14,600 on this. Stops can be placed just underneath 1,200. So the People's Bank of China have also said that, you know, and analysts are expecting them to cut interest rates. Now, if interest rates are cut, that's the exact opposite of what the Federal Reserve are doing, right? And that makes conditions more supportive for businesses. Similarly, China's government has said that they want to support the stock market in China. So all of that means there's lots of support fundamentally for Chinese stock markets. Now, the recent falls to start this week was on the news that Shanghai is being shut down, half the city, due to COVID-19 restrictions. Now, China currently has a zero COVID policy, COVID-free policy, but it remains to be seen whether they're going to keep that policy going. I mean, it's very, very unlikely that they will necessarily keep that policy going. And the reason it's unlikely they'll keep that policy going is because the rest of the world is changing that policy. It's very hard to keep a zero COVID-free policy when the rest of the world is starting to open up they're starting to open up their communities, are starting to open up in lots of different ways. So what we want to look at here is how do we take advantage of this potential gain but limit risk? And the obvious way is just keeping stops underneath that 1,200 region. That's the most obvious way to do that. But the rest of the stocks is pretty it's pretty neutral, and that's what we want to bear in mind at this moment. Right, so sort of quickly respond to a message. There we go. Right, lovely. Okay, so looking at this, that's what's going on with stocks. Now, I've entered a long on gold, and I'll explain why. If we get a stagflationary environment, gold longs make a lot of sense. Now, what doesn't support gold is the environment that we've seen today with yields surging higher, okay? Remember what moves gold. And what moves gold is a combination of the two following things. Let me just show you. Right, this is what moves gold. And it's the easy way to kind of get your hand on gold. When you see real yields rising, right, and the dollar rising, then that is negative for gold. So what you'll notice at the moment, we have some negative forces out for gold, with the real yields rising, the dollar rising. But look what's happening to gold. Gold is rising as well. Now there's a saying: if something can't rally on good news, if something can't fall on bad news, it can't fall at all. So this is telling me something important. Now, if you notice, when real yields fall, you see when real yields in the dollar falls, that boosts gold higher. You see back here, June, falling real yields, falling dollar, boosting gold. Falling real yields, falling dollar, boosting gold. Falling real yields, falling dollar, boosting gold. Now, when real yields rise and the dollar rises, gold falls. Now, at the moment, we've got a scenario where we've had real yields fall, but now they're starting to rise again. We've got the dollar rising. Now, that recent surge in gold was on the real yields falling back in sort of end of March, end of Feb, beginning of March. But now, today, you see, we've got gold pretty well supported despite the surge higher in 10-year yields. Now, that's been in the 10-year yields on the Bank of Japan policy action. We'll get back to that in a minute. So for me, I bought in today at 1930-ish with stops just underneath that 90.24 region, because I could have a very tight entry. If you just take a look here at the pivot points, this is around the S3 pivot point. You see, you got a very nice pivot point. Could keep stops nicely underneath this level. And you see the way that this is like a Harami inside bar, and you got this potential false break of a Harami inside bar. So reading that, and given the fact that we were testing that trend line and this trend line from the bottom, and I know that in a stagflationary environment, gold should gain. So I took a very, very tight entry with I've got a longer position that, I've got my stops underneath 1890, underneath 1900. But that was a very nice area to enter on the intraday charts, and I've managed to get in there, and that's worked pretty much perfectly. So that means if 10-year yields drop lower significantly today, then you'd expect gold to move higher. Now, 10-year in the yield curve, let me teach you something else if you don't already know. When you're looking at the yield curve, there's different kind of years to look at. So you've got your 5s, your 3s, your 7s, your 10s, your 2s, and then you've got your longers, your 30s, right? The short end of the yield curve, your 2-year, 3 years, they tend to move on interest rate expectations. So with interest rate expectations increasing, they tend to surge higher quicker. Your 10-year yields, they tend to move on growth prospects. So if growth prospects are expected to be hit, if US economic growth is expected to slow, then the longer end of the yield curve tends to fall. Now that is what makes a inversion of the yield curve. So here you have the 10s and the 2s. And if you notice, you see the 10s and the 2s are moving lower? That just tells you that the 10-year yield in relation to the 2s is falling more quickly than the 2s are rising. So this is, when this goes down to 0, that's the inversion of the yield curve. Now you can see the inversion of the yield curve is nearly there, right? Around this minus 0.000%. Now the reason markets look at that very carefully is because that is a recession indicator. And just take a look here, and this was a post I put on Twitter this morning, was this. And make sure, if you're not following me, follow me at Giles Cochran CCA, okay? That's my Twitter handle. Like every recession since the mid-1950s has been signaled by an inversion of the yield curve, with only one exception. So now you see what's going on. Markets are beginning to worry that perhaps a US recession is on the way because US growth is slowing. Right, that's the big narrative. Now, one area that I've seen to enter is on this. Now, that is still possible. The risk reward is not so good now. When I entered, my risk reward was fantastic on this. But it's still okay, because if this becomes, you see how that's an inside bar, if this closes within the body of this these two candles, that looks like a false break of an inside bar, which is a technical signal for higher prices. We know that if we get a stagflation environment, that's suitable for gold longs. So again, this is not trading advice or anything, but that's just saying this is what I'm doing and why I've done it. Now, obviously, price, if yields keep moving higher, if they go up, you know, it's up to 2.78, 3%, they keep moving higher, then gold can keep dropping lower. But remember what that's saying, if something can't sell off on bad news, then it can't sell off at all. So that's my rationale, and I'm looking for a move back up to 2000 and then 2050. That's just show you how you go about piecing some of these things together. Oil markets are slightly lower today on the news of the Shanghai lockdowns, less demand. If we see more lockdowns over China, that will reduce demand for oil. Copper prices slightly lower as well, very similar reasons. Iron ore and coal futures slightly down with the stronger dollar. Bitcoin pushing higher above that crucial 45,000 level. Just show you this technically. This has been pretty important for Bitcoin. Oh, that's Brent crude, sorry. There we go. I thought that looked odd. You can see here, just had a symmetrical triangle, just breaking out above that 45,000 region. There we go. That's a nice continuation structure, and that is supportive technically for further Bitcoin longs. Typically, you could look for a move back up technically from 33, 47. So you're looking about 13,000, so 45, 48, 58. So structurally, this is setting up for a longer move higher. Not something that I would trade, but look for this line to be support in the near term. We've covered the yield curve. The weakness in the yen has been on this move. Now, the Bank of Japan has said that they were going to keep the bond yield curve, keep the Japanese 10-year bond, the JGB, at 0%. They've got a band between plus 0.25 and minus 0.25. Now, that region, plus 0.25, minus 0.25, is the area where the Bank of Japan will intervene. Now, they've intervened with a special operation to keep the bond yield curve lower. So they're now buying JJBs at an unlimited amount to keep the bond yield curve down. Now, this is the catch. A weak yen is good for Japan's export market. That means that Japan's exports are more competitive overseas. But if the weak yen continues, that does make it difficult for some of Japan's import market, and some of the domestic market struggles with the import costs. So there's a tension, and eventually the Bank of Japan will get fed up with the weak yen, and that can result in, will they stop defending the yield curve? We have to remember they've set, I think, a couple of days they're going to defend it for now. But going forward, that might not always be the case. And sometimes they get fed up with the weak yen. Now, with the yen being so incredibly weak, and if we just look at the weakness of the yen that we've seen, and it's wow, this is the weakness in the yen. It's just been relentlessly weak. Look at that, multi-year low we're at now. So eventually they're going to get fed up with the weak yen. So that means don't chase these moves. Any opportunity to potentially go long on the yen pairs would be on something like maybe laser focus where you enter. So you can see here, New Zealand dollar yen moving right up to these levels, ridiculous. Maybe like a retracement back down to 82.50, going long makes sense with stops underneath 82, but don't be buying up at these levels because there's people buying in here, and they could have been buying in at the very top. Okay. Now the yen has seasonal weakness right now because of financial year end for Japan. So if you just look at the Aussie yen, do you see the weakness in the yen? Aussie yen upside, CAD yen, right? See weakness in the yen, US dollar yen, right? You see the picture. Now this yen weakness tends to tail off at the beginning of April. So we're getting quite close to a potential technical top in the yen pairs. So don't go chasing these levels, okay? But if you are going to go long, so like New Zealand dollar yen, because there is a yield differential between New Zealand 10-year and Japanese 10-year yield, like, you know, a retracement back down to 82.50 can be considered suitable for longs because you can define risk just underneath 82. Now, all of that has been necessary this week, so you need to see the context that the market is in. Now, the key things to look at this week are the US economic data points. If we start to see signs of slowing growth in the US, and particularly look at non-farm payrolls on Friday, now, employment data is a late cycle indicator. So there is every chance that this is still, employment's still good. But if this tails off and it's a big disappointment, we could suddenly see growth concerns really come to play, and that could result in some serious upside in gold, for instance. So keep your eyes carefully open. Out of these dates, the really thing to look for is slowing growth in the US. Now, there are some other data in the Eurozone. You know, is Germany heading for a recession? How is the Russian-Ukraine crisis weighing on the euro? That will be a story to kind of keep your eye on, but the best opportunity on the euro-US dollar would come if the Russian-Ukraine crisis fades. So if all of a sudden there's peace announced between Russia and Ukraine, you could expect the euro-US dollar pair to gain significantly. So euro-US dollar longs would make a lot of sense. And that's because, do you notice how the pound and the euro sold off very heavily since the Russia and Ukraine crisis really took on speed? That's because of the proximity of Europe to Russia. So if all of a sudden that fades, pound US dollar makes sense, euro US dollar longs make sense on a peace trade. Okay, folks. I'm just going to have a look. Yeah, can you give your thoughts on pound US dollar? Absolutely. Now, the pound has reasons for weakness because the Bank of England is more dovish. Yes, they're stressing inflationary pressures, but they're also seeing that growth is a problem at the moment as well. If you just take a look here, courtesy of Financial Source and the News Squawk, you will see on the central bank's side of things that Governor Bay says there's more to come on the shock income from inflation. Shock from energy prices this year will be larger than any single year. So very dovish talk for the pound. So the outlook for the United Kingdom is that the UK is likely to be struggling with higher energy costs. Now that's weakening the pound US dollar. Now, the expectations for a very hawkish Federal Reserve is giving the US dollar strength. So on an intraday basis, I would have a pound US dollar sell bias. So any retracements back up to that 13180, maybe even that 13150 region, can be considered suitable for sellers. But the medium-term outlook remains slightly unclear because of the factor of the dollar. If the US economic growth prospects get hit and we see a stagflationary environment, then we'd expect more dollar strength alongside gold strength, and that would play into the pound US dollar downside. But if US economic growth keeps going on very, very strongly, then we might expect the more rainbound action from the pound US dollar. At the moment, there's a downside bias and then reassess down at that 13020, 13050 region. That's the way I'm looking at pound US dollar, Patrick. Yeah, what do you think about Aussie yen and CAD yen, where yen is already oversold and Aussie is already overbought? Yeah, I think like it's always difficult picking tops, right? But I think if you had to trade the Aussie yen and the New Zealand dollar yen, then selling them makes sense because they're very, very extended. So if you're looking for a correction, one of the ways you can look for a correction in a market like this is you can trade like a trend line break. So maybe do a very tight trend line on the 1 hour chart or something. You could probably get it tighter here. So yeah, I'd say that like little trend line there. And like if that trend line breaks, go with it. You got to have your stops above 94.50. But that's when that's a bit of top picking going on, which you can do as long as you're managing your risk. I tried it with the dollar yen on Friday. Okay, so on Friday, and I tried to pick a top in the dollar yen, and I'll just show you using that same method. I'm expecting 10-year yields to correct because I'm expecting economic growth to slow. And we did on Friday have some slowing economic growth indicators, which was the pending home sales. See, pending home sales lower, University of Michigan consumer, everything yet lower. So I tried to sell dollar yen on the Friday here, right? And what you saw, yes, dollar yen broke through that 1 year 10 line, but then went back and went above it. Okay, so I got stopped out at like 122.50. So you can try and pick tops, but it doesn't always work out. Yeah, but that's what I'd say about that, Suman. Yeah, dollar yen. When you're trading the dollar yen, what you're really trading here is the US 10-year yields. So when the 10-year yields, do you see how closely, Nikita, the dollar yen tracks the US 10-year yields? So if all of a sudden, if growth prospects get hit, you'd expect the US dollar yen pair to move lower. So really, all you're trading here is what you're expecting from the US 10-year yields in the very short term. Okay. Looking at it, the other significant thing is that US dollar yen's up at this 125 region. Now, the last time dollar yen was up here, I think it was Governor Kuroda came in and said, like, that's enough yen weakness. And the Bank of Japan talked back the yen weakness. And then we saw the yen correct heavily lower. So that's why traders are very wary of taking it above this region, because this is the kind of level where historically the Bank of Japan has got worried. Remember I said about the yen weakness? It's okay, but there reaches a point when Japan doesn't like it. And that's when, historically in 2015, the Bank of Japan talked back against the yen weakness, and then we saw a correction. So that's what you need to look out for. So if you were like going like for a really speculative dollar yen short, like any retracements higher, or even at this level stops above the high, you just got to remember that you're trying to pick a top. And that sometimes it works out, sometimes it doesn't. New Zealand dollar is weaker than Aussie, so short New Zealand dollar yen for term. I think trading New Zealand dollar yen or Aussie yen is very similar, CN. The thing you got to remember is that you're going against the near-term momentum. But look, markets are overstretched. New Zealand dollar yen, Japanese yen. We're starting to see the yen pairs correct a little bit lower. That's all making sense. We're seeing 10-year yields. We just take a look at the 10-year yields. We're seeing a very similar picture with the 10-year yield. That surge higher. Now we're seeing a little bit of a correction lower. That's helping and has been helping gold upside. So you can, see the benefit of what I was doing here was I had that uber tight stop. So just think about it. If you're trying to pick a top, you can do that. Don't get into the habit of it. But when markets are really extended like this, that makes sense. But just make sure you're defining and limit your risk. Okay, folks. Been a pleasure. Don't forget, I will be back here on Wednesday. I'll be looking at NFP today, and I'll probably drilling in more to that US growth story. Been a pleasure as always. Thank you very much for attending the webinar, and I look forward to seeing you again next week. And on Wednesday, if not before. Thanks everyone now. Take care. Goodbye.